Hi everyone, welcome to our update on Netflix's quarterly report, quarter 2 23 from yesterday. This is an analysis and it's not investment tips, so check out our disclaimer if you want to know more. This is following on from our analysis of the Q1 report, but today focus on Q2. I've kept the slides from Q1 report in here because there's quite a bit of overlap, and where that is the case, where things are a continuous theme, I will point that out. Today, we'll be starting with focus on the financials, revenue and monetization numbers, which took a fair bit of center stage in this update. So here we're looking at their Q2 numbers, and the main observation was from the mainstream media, the 5.9 mil additions, but which beat the forecast, and that's a good news story. The share price nevertheless tanked after the update a fair bit, but as you probably know, leading up to it, it had gained a lot in, let's say, the previous 3 months. It had done extremely well, so it's just a little bit of a pullback probably. 8% year-on-year membership growth translated to 2.7% revenue growth. Main reasons for that is the lower ARM, average revenue per member, and that has to do with the addition late in the quarter, and that once again was triggered by the password crackdown, which started in different countries throughout the quarter. It had started in Q1 for the US and then was rolled out successively over many other countries throughout Q2. Also, a higher mix of additions in the lower ARM countries, and this had also to do with the new pricing model. As we've said last time, Netflix has actually introduced new pricing, lower pricing for countries with lower purchase power parity. And that obviously then leads to a lower average revenue per member in those countries and FX adjustments. So they were unfavorable on a broad basis. So these are the three main drivers. Operating margin has improved year on year to 22.3% from 19.8%, and even quarter on quarter by 1%. Main reasons were cost management, so take that one with a grain of salt, slower headcount growth, and timing of content. The latter two were very much driven by the actor strike. A few words throughout this presentation on that one. Revenue growth in forecast for the next quarter is 7.5% growth, and that will be mainly driven by subscriber growth. ARM is expected to remain flat, and that has to do with their decision not to increase membership pricing during the other two major changes that they have, which is the password crackdown, or as they call it, extra membership, and the introduction of ad layer, as well as basically the new pricing model for many of the countries with lower purchase power parity. And what they're saying is that ARM will remain flat because extra membership are not yet fully materializing and not yet offsetting for the lack of price increase. Note on that one, very important, the extra membership accounts are not included as separate paid memberships, but added onto the primary account as an additional ARM, which is additional revenue per member. So very interesting. And that is, let's continue on a regional breakdown, but we'll come back on that observation. So observation is that the ARM is going down, as you can see here, compared to basically Q3 22. And in the interview, they are calling out that they didn't want to touch pricing during the major changes. That makes sense from a number of perspectives, including the ability to track what causes what. You don't want to experiment or pull too many levers at once because you're not going to be able to clearly identify which change has led to which outcome. And that's a major and a good management principle for sure. They're pointing out their plan to increase membership pricing once the impacts of those major changes in the recent past have tapered and settled, which they expect to happen over the next couple of quarters, 2-3 quarters. Interesting though, ARM has reduced despite the fact that extra memberships are added to the ARM of the primary member. They haven't given any quantitative updates, but one could probably conclude from that the extra membership uptake is probably not huge at this stage. And they are saying that they're expecting a rolling uptake as appropriate content comes online for the people. Question on that one also, with membership not having grown significantly and revenue year-on-year tapering, is our question: how much of a bargaining position do they actually have to increase pricing without stalling growth? I'm not going to give you the answer because I don't know it just as much as they don't know it, but I believe it's an interesting question. Looking at the other regions in the summary, it's a mixed bag of results, to be honest. Europe, Middle East, and Africa, 2.5 million subs growth, quarter on quarter, very good. Revenue down, even on an FX adjusted basis. And year on year, 10% subs growth, which is good, and 4% revenue growth. So basically, that tells us that the ARM has gone down. LATAM, healthy growth in memberships as well as FX adjusted revenue. ARM has been flat. It is an area that for a long time they've been trying to nurture. It's pretty much in front of their doorstep, and they've been trying to nurture it with appropriate content over many years now. And APAC, so maybe split out. So overall, 15% membership growth, yet negligible revenue growth year on year. Long-term plan, clearly called out, is to grow the subscribers and then over time increase pricing and features. So that was not called out this time, but that was hinted at last time when they were talking about the new pricing models being rolled out to the likes of India, etc. So in this region, we probably have to separate further without having any detailed numbers, Asia from the Pacific. So Australia and New Zealand certainly going to be quite different from India in this respect. All right, so that's the financial numbers. This was the Q1 report update in the business model canvas. Now, this is the Q2 report in the business model canvas. So the things that are new in Q2 are shown in red. Starting with key activities. So some content has been pushed out. So creating content is their main key activity, I would say, other than marketing. But so some content pushed out due to the actors' strike already mentioned. But interestingly, so their key resources certainly are also actors and content. Nothing mentioned really there. During the interview, Ted Sarantos mentioned that he comes from a union family and has a lot of understanding, but also made pretty clear that they're not going to budge to terms that they don't agree with. So let's see how that will unfold. But there are definitely delays to their content library. Again, they call it Slate, a very US terminology. Depending on how long that continues, it may have impact down the track. But as we've said many times, there's a 1 or sometimes 2 year delay between these activities and the content coming online. So I'm sure they'll be working on that phasing. Value propositions, really the main thing, and we'll be talking a little bit more about it in the next few slides, is more emphasis on variety, which was great to hear. Because we have addressed it last time in our last video. You don't need to watch that video first. You can watch it later if you're interested in this topic. Variety being very important for global growth. And personalization is important because if you have a lot of different content, you need to match the content with your customers. So that's where the stellar discovery engine comes into play. Then updates on customer relationships. I'll talk about it in a moment. Again, continually piercing the zeitgeist with consumer passion and fandom. Yeah, very interesting statement, and certainly true. That is gaining loyalty through these kind of getting the content right. And as I mentioned, so they, on the customer segments, expectation of rolling segments to subscribe after the password crackdown, clearly called out by one of the execs during the interview, and they definitely believe that this will happen when the right content comes for the different customer segments. So they are talking about 1, 2, or even 3 quarters for that to fully materialize. Cost structure, as we've already mentioned, the cost structure went down. The operating margin improved not because the revenue went up so much, but more because of the cost base going down. And that was certainly to an extent driven by the actor strike, because content investment in content had to be slowed down or pushed out in some cases. And they're saying that this will lead to a lumpiness in free cash flow forecasts across financial years 23 and 24. No surprise here, completely understandable. Revenues, so these were already there. New pricing models, i.e., lower prices for 116 countries, in particular with lower purchase power parity. Extra member accounts, no real quantitative updates other than what I already mentioned a couple of times, that they think this will take a number of quarters to materialize. Advertising-based layer, I'll just say a few words in a moment. And just the general growth is expected to come from volume for now, because as we've mentioned, they don't want to touch the pricing, and they haven't touched the pricing for a little while because they just didn't want to conflate or do many things at once. They are talking in the near or medium term to introduce new feature points as well as higher pricing for that, and have more differentiated plans. So when they in the past were really very focused on having a single offer, a very simple pricing plan, now they're going to be more differentiated in that. And we see that across many tech players. This is a very normal trajectory. Advertising-based layer, so let's now move on. We're adding more boxes to our business model canvas because really it is a new type of customer, advertisers. So advertising-based layer, they said this was 100% growth quarter on quarter, but starting from a very low base, obviously. And when pressed on that by the interviewer, they basically said their long-term goal is for this layer to deliver around 10% of their revenue. And yeah, they didn't want to go any higher than that, but they said for them to be worth their time, efforts, costs, etc., that is what they are aiming for. On the key partner side, then, Microsoft is a key partner in the advertising delivery, and Nielsen and EDO are partners in the measurement space of ads, and building an ad platform. So they got tens of engineers internally on that one, and they were calling out that Microsoft has additional engineers. So yeah, interesting. Advertisers, value proposition for advertisers, very, very interesting there. They were asked whether they want to be on the digital advertising space, and they said that that will take a long time. And this really ties into what I've said last time and what you can read in the blog entry from the Q1 report. They don't yet have the data that other digital advertisers have. And when I say that, we're referring to search and social platforms, which have a lot more data about their users. Like, imagine all the data that Facebook has and allows targeting. So you can check out our premium resources on the 11 verticals, where we are clearly pointing out what capabilities there are in the search and social space in terms of digital advertising. They clearly said in the near and medium term, their ads will be around brand ads. So more relating and similar to traditional TV ads, simply because they don't yet have the targeting capabilities. But what they called out, and interestingly so, buying ad space in their top 10 movies. Well, if you know about advertising during the Super Bowl, let's say you do know that that is a very lucrative advertising market. So they say overall, that's what they're going to be focusing on in the near term. They are very realistic about building a digital advertising business is humongous work. And yeah, in our premium resources, you can see that how true that it actually is. They said that currently advertising has a good demand in an overall soft market. It is known that the advertising market currently is soft. Now, next big topic and area that I keep on banging about for years and many years, and that will stay so: engagement. So these are the slides from the last Q1. I will skip these because these are still available to be looked up on their website. So if you're interested in that, you can look it up in the Q1 video that we've got on this channel. But in Q2, updated metrics. So now they've been updating, provided more engagement, aggregated engagement data on their top 10, and they're pretty much encouraging others to do the same. So engagement in general. What are they saying about it? We focus on engagement because it is the best proxy we have for satisfaction. It's also closely linked to retention, an important driver of our business. Well, can't be overstated, I guess. Key for Netflix members is the variety and quality of our content, with the understanding that quality is in the eye of the beholder. The combination of content variety and personalization means that each person easily finds the titles that they will love. That's where they talk about the stellar discovery engine being one of their key focus areas for further development. And they have added, so this is part of their top 10 page. This is what we knew and which is still there, and this is what is new since last time. So, which I found really interesting. If you check out our video on the Q1 report, we have picked up on exactly this point, which is, okay, the content is good for certainly, let's say, Western taste. That can include Central Europe and Scandinavia and obviously Canada, UK, US. But what about other countries? What about a global audience? Lots of updates on that one. And it's not even the detail of it that matters, but it is that they are acknowledging this point. So they're saying, if you aspire to serve hundreds of millions of people all around the world, you can't program for one set of tastes or sensibilities. Invest across genres, cultures, and languages. All these titles not only hit Netflix's top 10 list in their own country, but also across multiple countries and our global top 10, showing that with good subtitled dubbing plus easy discovery, great stories can truly come from anywhere and excite audiences everywhere. Even in the US, which has historically had an incredibly local viewing habits, we've seen non-English language titles gain increasing popularity. Well, all of this is good, but take note that this is Netflix global top 10. So it's not an objective top 10 that takes into account other platforms' content. Is a question, the questions that we asked last time will just remain the same. Will their investment cycle be good enough to cover the tastes and create consistently a large enough content library for many tastes to be served? And we still believe that, let's say, take India being a very large market, some streaming provider who mainly caters for India and then puts in some other foreign content, they could have a much bigger advantage just because they can focus their financial resources on this market alone than the likes of Netflix, who try to serve so many tastes. And again, if you look at our resources, our detailed premium resources, you see the staggering numbers. We're talking about a $17 billion yearly content creation cycle on the side of Netflix. So imagine you try to do that for many countries. That's not going to be an easy feat to pull. You can look at these slides in the Q1 report. I'm not covering them again, which is where we have basically talked to all of these topics. Again, I can only say, if you check our premium resources, you'll find a lot more background knowledge on all of what we've just discussed. Fourth and last point, competition. Now, this is what they were talking about last time, Netflix's share of viewing across all screens. This time they've changed their reporting. Well, it's not really reporting, but they've chosen a different data point. And my tip, if you want to understand a company, you do and you see they're reporting differently all of a sudden, go into the details and try to understand why. It could be that they haven't tracked as well as they were hoping across the old metrics. And so here, basically, they're comparing May 21 to June 23. And in those 2 years, streaming has taken a lot more of the screen time in the US on US TV screens. So this is TV screens. It's not all screens anymore, i.e. mainly laptop and phone and tablet screens are not included here. Netflix has grown their overall share from 6 to 8.2%. Certainly great progress and growth there. But they're also calling out the increased landscape of competitors. Well, that's pretty obvious here. Streaming in itself has grown from 26 to 37%, but now shared amongst more competitors, and some of them were also on some of the other channels previously. So, calling out major types of competitors, movies, TV, where they play, but also sports and news, gaming, social media, but there's more than that, of course. Gaming, that could be part of the growth of the other category, which we really should not be ignoring. That's a pretty significant growth as well in there. Then direct streaming competitors, they're distinguishing between entertainment competitors, so those that have come from the typical entertainment space like Disney, Comcast, etc. So previously content for TV and cinemas, and tech competitors, which currently do not necessarily have their own large content libraries, but they are investing heavily. YouTube has a huge content library, larger than anyone else, but it is user-generated content or third-party content. But YouTube certainly, as you can see, has grown faster than Netflix, and without any doubt, one of the biggest competitors. Linear programming doesn't get much of airtime in this update, other than kind of a punching bag and the area where they want to take market share from. Is it justified? Maybe not. I think the main downside of linear programming is that they don't have their own growing content library that is up to date. They are certainly investing in not being linear anymore. Most of the broadcast and cable channels now have apps where you can watch on demand as well. But yeah, the content library is certainly updating rapidly. This was their overall stance on competition in Q1. You can look it up in the Q1 video. Q2 summary is this one. Not going to go through everything, but they're pointing out having to be strong in both entertainment and technology. And interestingly, during the interview, they were asked around M&As, mergers and acquisitions, and Ted jumped in immediately and said, well, we are builders rather than buyers and have been so for a long time. So Ted, who's been in the senior exec management for 20 plus years, is not surprising that he says that. When he was asked whether they're interested in acquiring some of the troubled content assets, of which there are plenty, he pretty much refused that. Again, no surprise, because he's been kind of the father of the Netflix's original content. But he pointed out IP is where, if they looked around, they'd be interested in, and he left it at that. And I think we can be pretty sure what kind of IP we're talking about. That is AI, and that is really fitting in the context of the current strikes, because streaming companies want to reduce their cost base by being able to kind of do the non-main characters through AI. And that's it for